Hello, bosses. Welcome back to Boss Economic World. I'm your host, cutting through the noise, shredding the jargon, and telling you who's getting rich and who's getting rugged. Today is December 3rd, 2025. Happy holidays, everyone. But guess who isn't feeling the Christmas spirit? The Bank of England. While you were busy shopping for Cyber Monday deals, the old lady of Threadneedle Street, our dear central bank, was busy having a panic attack. Why? Because there is a bomb ticking under the floorboards of the British economy. It's not inflation, it's not GDP. It is a £100 billion pile of leverage that just hit an all-time high. They call it the basis trade. It sounds boring, right? It sounds like something your accountant mumbles about before you fall asleep. But let me tell you the truth, looking at the data released yesterday, this is the financial equivalent of picking up pennies in front of a steamroller, while blindfolded, on a sheet of black ice. Today, we are going to break down exactly what the Bank of England warned us about yesterday. We're going to explain how US hedge funds have essentially hijacked the UK government bond market, why the repo market is the scariest pawnshop on earth, and why a £100 billion unwind could make the 2022 LDI crisis look like a tea party. Buckle up, bosses. Let's follow the money. Alright, let's look at the news. Yesterday, Tuesday, December 2nd, the Bank of England dropped their financial stability report. Usually, these things are great for curing insomnia. Not this one. Here is the headline number, £100 billion. That is the net amount of gilt repo borrowing by hedge funds as of November 2025. Let's put that in context. Back in June, just 6 months ago, this number was estimated at £77 billion. That means in half a year, while everyone was talking about the soft landing, hedge funds ramped up their borrowing by nearly 30%. It is the highest level since data collection began. We are in uncharted waters, folks. So, what is the Bo saying? They are screaming, politely, because they are British, but they are screaming. They warned that market participants need to manage their risk-taking to avoid a disruptive unwinding. Translation, you guys are leveraged to the eyeballs, and if you all try to sell at the same time, you're going to crash the gilt market, spike interest rates, and break the financial plumbing. And here is the kicker, the dirty little secret that the Bo highlighted, 60% of this activity is coming from managers in the United States. That's right. The stability of the United Kingdom's sovereign debt is currently resting in the hands of a few guys in Connecticut wearing Patagonia vests. We have effectively outsourced our bond market stability to Wall Street algos. Now, I know some of you are thinking, boss, what is a basis trade? Why do I care about repos? Let me break it down. No PhD required. Imagine you go to a store. You see a bag of coffee selling for £10. But you know that next door, a contract to buy that same coffee next month is selling for £10 and 5 pence. There is a 5-penny difference. This is an inefficiency. In the bond market, this happens between the cash bond and the futures contract. Normally, these prices should move together. But sometimes, asset managers buy futures to hedge their risks. They don't care about the price, they just need the insurance. Their demand pushes the futures price up slightly higher than the cash price. Enter the hedge fund. The smart money. They see this tiny gap. They say, I can make a risk-free profit. They buy the cheap cash bond and sell the expensive future. They lock in the difference. But wait. The difference is tiny. It's like 0.01%. If you invest £100, you make a penny. You can't buy a yacht with pennies. So, what do? You use leverage. You go to the repo market. The repo market is basically a giant pawnshop for banks. The hedge fund takes the gilt they just bought, walks into the pawnshop, and says, here, hold this gilt as collateral. Loan me cash. The pawnshop gives them cash. The hedge fund takes that cash and buys another gilt. Then they pawn that gilt, get more cash, and buy another gilt. They repeat this 50, 60, maybe 70 times. Suddenly, that 0.01% profit, multiplied by 50 times leverage, becomes a 10% or 15% return. And because the bond and the future converge at the end, it feels like free money. It's the ultimate arbitrage. But here is the trap. This strategy relies on two things. 1. Liquidity, being able to trade easily. 2. The pawnshop staying open. If the price of gilts drops suddenly, like a shock the Bo mentioned, the pawnshop gets nervous. They make a margin call. They say, hey, that collateral you gave us is worth less. Give us more cash. Now. If the hedge fund doesn't have the cash, they have to sell the bonds. But if everyone has to sell the bonds at the same time, prices crash. The pawnshop asks for more cash. More selling. This is the feedback loop the Bo is terrified of. It's a fire sale in a crowded theater, and the exit door is the size of a cat flap. The Bo report dropped a terrifying stat yesterday, a small number of hedge funds account for more than 90% of net gilt repo borrowing. Let that sink in. 90%. This isn't a broad market phenomenon. This is a handful of massive whales, mostly American, who are all betting on the exact same thing. This is what we call a crowded trade. Sarah Breeden, the BOE's deputy governor for financial stability, said yesterday, the resilience of the gilt repo market is fundamental to the resilience of the sovereign bond market, which is the basis on which all financial market activity in the UK takes place. Let me translate central banker speak into boss speak. If the repo market breaks, the gilt market breaks. If the gilt market breaks, the UK government can't borrow money. If the government can't borrow, interest rates skyrocket, mortgages blow up, and the pound crashes. She is telling us that the entire foundation of UK finance is currently resting on a Jenga tower built by leveraged speculators. And why is this happening now? Why 2025? Because throughout 2024 and 2025, as interest rates stabilized, volatility dropped. When volatility drops, hedge funds feel safe increasing their leverage. They got comfortable. They got greedy. They looked at the £77 billion in June and said, rookie numbers. Let's pump it to £100 billion by Christmas. The opacity is the problem. The BOE explicitly said the opacity of parts of the gilt repo market hinders them. They don't even know exactly who holds the grenade pin. They just know the grenade is in the room. So, why doesn't the BOE just stop it? They tried. Oh, they tried. A few months ago, the BOE proposed a solution: minimum haircuts. In the repo world, a haircut is the safety margin. If you pawn a £100 bond, and the bank gives you £99, the haircut is £1. It limits how much you can borrow. The BOE wanted to increase that haircut. If they force banks to lend less against the bonds, the hedge funds can't leverage up 50 times. Maybe only 20 times. It makes the system safer. But guess what happened last month? The lobbyists arrived. The trade associations, the hedge fund reps, the industry groups, they all wrote angry letters. They rebuked the proposal. Their argument? If you impose haircuts, you will harm liquidity. You will make it harder to buy and sell bonds. It will cost the UK taxpayer more to borrow money. And this brings us to the paradox, the truth behind the event. The BOE is being held hostage. On one hand, the BOE needs these hedge funds. The report admitted it. They said, leveraged market participants can often serve a useful function, improving market liquidity and price discovery. Since the banks stopped holding huge inventories of bonds after the 2008 regulations, hedge funds became the new market makers. They provide the grease that keeps the wheels turning. But on the other hand, that grease is highly flammable. If the BOE cracks down too hard, the hedge funds leave. Liquidity dries up. Yields go up. The government pays more interest. If the BOE does nothing, the leverage bubble grows until it pops, causing a financial crisis. It is a game of chicken. And right now, with £100 billion on the line, the hedge funds are blinking their lights and honking the horn, daring the BOE to move. Listen, friends. We are sitting here in December 2025. The global economy is fragile. We have divergence between the Fed and the ECB. We have geopolitical tensions affecting oil prices. The BOE mentioned correlation shifts outside historical norms. That's fancy talk for stuff happens that shouldn't happen. Remember September 2022? The Liz Truss mini-budget? That wasn't a basis trade issue, that was an LDI issue. But the mechanism was the same, forced selling into a falling market. Pension funds got margin calls. They had to sell gilts. The selling crashed the price. They got more margin calls. The BOE had to step in and print billions to save the country. The basis trade is the sister of the LDI crisis. But this time, the numbers are bigger, and the players are foreign hedge funds who have zero loyalty to the UK economy. If they smell smoke, they won't stand and fight. They will hit the sell button and retreat to the Hamptons. If this trade unwinds disorderly, 1. Gilt yield spike, that means your mortgage rate goes up. Again. S2. Turling volatility, the pound bounces around like a rubber ball, hurting importers and increasing inflation. 3. Credit crunch, banks get scared and stop lending to real businesses. This isn't just Wall Street gambling. This is your wallet. So, what is the truth? What is really happening behind the scenes? The truth is that the financial system has become addicted to leverage to squeeze out returns in a high-efficiency world. We have created a system where risk-free arbitrage is the most dangerous game in town. The BOE knows they are late. That £100 billion figure is a lagging indicator. It's already happened. The risk is already in the system. Sarah Breeden said they will respond to industry feedback soon. That's code for we are trying to figure out how to deflate this balloon without popping it. My prediction? The BOE will likely blink on the harsh regulations. They are too afraid of drying up liquidity before the year end. They will issue stern warnings, they might slap some minor reporting requirements, but they won't force the massive haircuts yet. They are hoping the market self-corrects. But hope is not a strategy. For you, the investor, the takeaway is clear: watch the repo rates. Watch the gilt yields. If you see a sudden, unexplained spike in UK yields while US treasuries are flat, that is the canary in the coal mine. That is the basis trade unwinding. We are living in a world of shadow banking, bosses. The official banks are safe, but the shadow banks, the hedge funds, the repo desks are running the show. This £100 billion isn't investment. It's a leverage tower. And in economics, the taller the tower, the messier the fall. Stay liquid. Stay alert. And don't leverage your house to buy pennies. I'm Boss Economic World. Like, subscribe, and I'll see you in the next one.